Yeah, so I welcome all us to this video. And so we have gotten to the second stage of the video where we'll be talking about liquidity. So here we'll be talking about liquidity. We're talking about liquidity. So we have major three types of liquidity. The first one is what we call inducement. The second one is what we call incomplete pullback. And the third one we call a traplex. 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 Alright, the first one I will talk about, which is which are inducement levels, are the one we call primary inducement and secondary inducement. What do we call primary inducements? They are first high after break of structure. Every first high after break of structure, they are inducements. Market to what? They are not, they are fake highs. They are fake highs. They are liquidity. The market will take. They are traps. You understand? So if you have a move like this, you have something like this, market is going down, and suddenly market created what? Up, broke what? The downtrend. The first high market creates is an inducement. The first high market creates after a break of structure is an inducement. So for example, let's assume we have this. For example, let's assume we have this. And we have this. Market is formally in a downtrend. So yes, we have this. So the first high after a break of structure is our primary what? Our primary inducement. Is our primary inducement. So the first high after a break of structure is our primary inducement. That high is a fake high. It's what market what take that high. So after that, market continue going up to the upside, Market broke out of the external liquidity here. So let's assume we have this. You have this market is coming from a downtrend. So which means that what? These are low. These are external liquidity. So these are external liquidity. These are another major liquidity. These are our next external liquidity that we want to take. So immediately afterwards, market break out of the what? The external liquidity. The first high it creates is a liquidity. That high too is a liquidity. Is what we call secondary liquidity. That high is what we call secondary liquidity. You can use that high to continue and create range structure. Creating range structure. But it does not mean that high is still not a liquidity. Every high after a major or minor break of structure, there are liquidities. These are what? Liquidity. These are what we call inducement levels. Inducement levels. Those are what we call inducement level. So primary is the primary inducement, the first high after a break of structure. That's what a primary inducement. After the major break of structure, the first high is the secondary inducement. So now inducement is what separates levels. You understand? Inducement is what separates levels. Now this is the primary zone. Yeah. From the first inducement, because it is in the inducement that the market will come and induce, and what continuation? It is after the inducement the market will continue. It is liquidity the market is looking for in the market. Do you understand? It is liquidity. Do you understand? It is liquidity the market is looking for in the market. What market is looking for is liquidity. So after market taking the liquidity, what market do? Market will continue. That's why. So this is what makes this point a POI, is because after taking the liquidity, market will come to a good point and continue. That's the primary zone. These are the internal structures. Everything here are the internal structures. You understand? They are the internal structures. Market can come there too and continue. You understand? So after market has taken this liquidity, secondary liquidity, market can come to this what? Market take what? A secondary liquidity, come to this point and continue. That's it. It has taken the secondary liquidity. Or market can come and now and break this what? Break this internal structure. Give us a retracement. You think it's going now. Come to the primary zone. Take this primary liquidity. The first eye, it creates and then continue. That's why market will always look for liquidities. You understand? And the concept behind liquidity is that there are many institutions in the market, and they want to have less resistance or low resistance so that they can be able to move in their direction. Everybody wants market to move in their direction. You understand? So they try to liquidate others, so that they can have low resistance in their direction. You understand? So that is how it is. That is how it is. That is how it is. So those are liquidities. That's the first liquidity that we have. They are inducement levels. Inducement levels. Those are the first one we have. After first break of structure, after second break of structure, that's what we have. What the next one? They are what? Second one we have. They are what? What we call incomplete pullback. Incomplete pullback. They happen within internal structures and range structure very well. For example, if we have this downtrend, market creating what? Creating this. Market broke structure here. Go to have primary inducement, continued, come here, mitigated it, come here, mitigated it, create something like this, created this, broke structure, created this, and create this. For example, if you have this, for example, I want to talk about the incomplete pullback. It happens, there are liquidities. That's the second type of liquidity. You can't see more than those liquidity. Incomplete pullbacks. So for example, we have this. Market broke out of this point, making this our primary liquidity. Making this our primary liquidity. Making this our primary liquidity. After that, market continue internal structure. But can you see within the internal structure, can you see that market was creating deep pullback? Deep pullback into what? Can you see that within the internal structure, market was creating deep pullback? Was creating deep pullback into what? Into structure. But this did not create a deep pullback into structure. It only created what? An incomplete pullback. An incomplete pullback. An incomplete pullback. Which means what? There's an imbalance between here, this structure, and this structure. There's an imbalance between this structure and this structure. That imbalance is what makes this point a valid point. So it means this incomplete pullback is an inducement. It's a liquidity. It's not an inducement, a liquidity. And market can come back and take it as liquidity and continue selling. That's what we call incomplete pullback. Incomplete pullback. Any pullback that is not what? It's not complete. It's not above 50%. Sometimes even if it's above 50%, but there's still what valid imbalance above it. There's still a good imbalance above it. Market can use it what as what? As what? As liquidity. Market to what? Continue. You understand? So that is that about that. That is that about that. So this about what? In liquidity. How is it a liquidity? Because is what? It's incomplete. It didn't pull back as these other ones were pulling back. Do you understand? So that is that about that. Another one. Okay, let me just explain this now. What is this? What will you call this? This is our what? Our secondary liquidity. That's our secondary liquidity. Why? It is the liquidity that market creates after a major break of structure. Can you see if you're having this low, our lower low, our lower high, our lower low. This after market broke out of this is the first high it creates. That's inducement level, our secondary inducement level. So market can come like this. Take this high, just this high, and continue. You will not be surprised that what the market now use. As the market now, you will not be surprised that this is 1, this is 2, this is 3. Why the market now take this and not leave the 2? That's because you don't understand that this one is an inducement. It's not the same. They are not the same. This one and this one are the same. Because why? This one are the same because this one created a deep pullback into it. But this one is not the same as this two. Why? Market has already broken here before creating it, making it a secondary inducement. So market can come here, take this high, and continue. That's what liquidity. That is liquidity. That is liquidity. You understand? So that is it. So also we can have a range structure too. You can have what? You can have what? Incomplete pullback in range structure. So when does the market what? After market broke here, market was creating a series of range structure. After market broke this, market started creating range structure. We can create something like this. Range structure. Range structure. So within the range structure, now this is range structure because after market broke out of it, every structure the market's creating after it broke out of major external liquidity, it's a range structure. So range structure and internal structure, they are what? They are twins. They are together. It is the same thing that market. It is the same way that market react to them. Range structure and internal structure, they are twins. They are the same thing. It is the same way that markets react to them. Do you understand? So can you see that market what? After market was created this. Market was creating deep pullback to this. Deep pullback to this. But this one didn't create a deep pullback to this. It just what? Created this small incomplete pullback. So even within the range structure, that's why they said they are twins. Market what? This guy can be used, and this eye can serve as a what? As a liquidity. What type of liquidity? Incomplete pullback. This eye can serve as a liquidity. You now see markets come like this, come here, and continue. It's still within the range structure. It's still range structure. But even within the range structure, there's mitigation. That's what we call mitigation within the range structure. Do you understand? Because this is an incomplete pullback. You get it? So that is how it is. It's the same thing with internal structure also. That's what we call incomplete pullback. When there's a valid imbalance above a pullback, when market did not pull back into orders. If orders are like this, they are creating retracement, retracement into it, and then there's one just one just like this, and just continue. You can't say they are the same structure. No, they are not the same, because this is what a pullback that is not complete. This is a shallow pullback. So market can come to this level, and what? And continue. This will now serve as what? As a liquidity. This will now serve as a liquidity for that level, for market to come there and continue. Boom. That's it. Do you understand? So that is that about that. It is that about that. So the third type of liquidity that you need to look out for is what we call trap legs. Trap legs. It's very powerful. Trap legs. Okay, well, how do we find trap legs? Okay, this is what we call trap legs. We can use it in primary zone, use it in internal structure, or use it in range structure. Internal structure and range structure most of the time. So if market is going down, this is it. There are two ways actually to know trap legs. Market is creating this. If markets come back here and take this high and create a lower low, and add like this, and add like this. So you see the structure. If you're looking at the structure, you think that okay, if market is coming back, market has what? This one has given us a deep pullback. What should I do? Let me just sell from here. But you must notice that market will do. Market will come. It will do as though you want to sell a bit. It will come here, come to this point and sell. It's not eat your stop. You're not really here. What is my stop loss? It's because you don't know that what this is liquidity. What type of liquidity? That's what we call trap leg. Trap legs. Liquidity. Why is it trap legs? It's because what? Marketers were taking liquidity from the last side. So this eye is our strong eye. You understand? So this one can become a liquidity towards our strong eye, such that market will read it, and what after market reading it, market will come to our strong eye. Before continuing, that's what we call trap legs. I'll show you everything. I'll show you the three in chart. That's what we call trap legs. So that's it. So you want to check the left side of your where you want to be buying if there is trap leg there. If I have this, market is going, and sometimes you might not even be able to see it. That's it. That's something like this. If market is coming back, you're thinking that market should just continue from here. Market will come like this, come to this point, and give you an eye. You're not surprised. Why did the market come here? For this one, they are deep pullback now. They are deep pullback already. Why did the market now come to them again? You understand? See, like this one, they are deep pullback, but they are still liquidity. Why are they liquidity? Because what? This eye is a trap leg. This eye, they are trap leg because this eye is a strong eye. How is it a strong eye? Clear liquidity. After clearing liquidity, becomes a strong eye. After becoming a strong eye, broke structure. After breaking structure, the first time you create inducement. After inducement, they come as what? As they become liquidity. Market come there. And what? Market continue. So that's what we call trap leg. That's number one. kind of trap leg. So the second kind of trap leg we have is when market is close to a POI, point of interest. This market wanted to buy from here. Market can give us fake legs. Market is selling lower low, lower high, lower low, lower high, lower low, lower high, lower low. Market to just tap into it and give you a big move to the upside. You think market has changed structure? That's what it can be, a trap leg. Market will now come, clear it, give you another push, and now start a real move. So that's also a trap leg. So everything I'm teaching you, they are trapping actually. But as everything they enter, like they are interwoven. That's it. Everything is interwoven. You can't teach liquidity alone without talking about them because they are together. Structure is together with liquidity. Liquidity is together with entry. That's it. You understand? So this leg is your inducement trap leg. That's what we call inducement trap leg because it's a trap leg. Many people are already buying, but what it cleared what the liquidity and it now started buying. So this low is now the what? It's now a strong low. You see the same pattern playing out, the strong low pattern playing out everywhere. That's all you need. If you can identify protected lows, strong lows, you are okay, you are good. You understand? You are so good. So that is that. About that. So that's liquidity we have. First one is what we call inducement levels, incomplete pullbacks, and what and trap legs. That's all. That is what all.